Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
With thrift savings plan accounts nosediving and Doge possibly coming for your job, no wonder federal employees are on edge. Times like these demand, though, your calmest and clearest thinking, and here to help, certified financial planner Thiago Glieger. Thiago, good to have you back.
Thanks, Tom. Good to be here.
And let's talk about the concept of the war chest. I think a lot of people are thinking about the oh my God money, as some people call it. What are your thoughts on a war chest, how you build it, how big it should be, and what's the most efficient way, pardon the pun, for using it?
It's really important, Tom, so I'm glad you bring that up. The war chest is often the reserve that we have aside for a specific time. And so in financial planning, this is typically when the markets or the economy starts to fall apart, right? Commonly used term for this is the short-term bucket. And so the idea behind it is that your highest priority during turbulent times is that you can have peace of mind when things get uncertain. If you are caught unprepared, you could find yourself selling investments at a loss to meet any kind of short-term expenses. And I'll tell you, when the markets fall apart, that's also when the water heater breaks. It's when the car has to be replaced, right? So all of these things we need to be prepared for. And especially as you're coming up to retirement. You know, I was talking to somebody a couple of months ago. They retired at the end of the year, and they had a really successful career as a high-ranking person, very smart, very well-educated, big TSP account, and they had been very aggressive their whole career. So CS&I funds didn't really have this war chest in place. Well, as we know, the market started going crazy a few weeks ago, and he's watching hundreds of thousands of dollars peel away and disappear from his TSP account. So he's retired and really worried about this, and so he's trying to protect it from falling even more, sells, and the very next day the markets do what? Go up 10%, right? And so this drive to try and protect our money is very, very strong in retirement, and the war chest helps us prevent that.
Yes, those are the two biggest mistakes you can make, I guess. One is to sell high one is to sell low and buy high, which people do in this panic, and the other is to try to time the market.
That's right, and we can't know exactly when the markets are going to do their thing. They typically do it very fast and very hard when it comes around, and if you're not prepared with the allocation ahead of time, you're very, very likely to miss out. And so that's where we talk to people about considering how much they should have inside their TSP accounts, or really their whole portfolio to include the bank accounts, things like that. I like to see that number, Tom, somewhere between 6 to 12 months of their expenses in more conservative liquid assets. And there's a bunch of different investments that they can choose for that.
Yes, so the idea is that don't sacrifice your long-term gains because you're afraid of volatility in the TSP, and the way you do that is to leave it there, basically, because over time it's going to grow, and at the same time have this oh my God fund or short-term bucket so that you can leave the TSP where it is.
That's right. It's different tools for different jobs, right? Your stocks are the inflation-fighting, growth-creating tool that we use in our portfolio. But what is the price that we pay for long-term opportunity of growth? Short-term volatility, right? We don't know what it does in the short term. So I encourage federal employees to look at other things like cash in the bank. If you have too much cash, it's not working for you. So that's where you could use CDs or treasury bonds, but then you have to deal with Treasury Direct. And a lot of people don't like to do that, having a different account somewhere else. Or you could just buy treasury inside your portfolio. But the idea is investments in other asset classes that are protected from that volatility.
Or you could have just another account that is not a retirement account, not a TSP, or if you're a contractor, not a 401k or an IRA, but just simply have a account that is liquid without any tax penalty. That way.
That's exactly right. And in fact, that's the other big area that we see a lot of people focusing on this year as the markets fall apart is these non-retirement accounts, because you do have a lot of flexibility like tax loss harvesting.
And, well, you will get to that in a second. But in the meantime, to build up that short-term bucket, you have to, all the time throughout the year, pay attention to spending and make sure that part of your diversions from your paycheck are beyond the TSP, which gets matching, but to this bucket.
That's right. The TSP match up to 5% is essentially a guaranteed double on your money. We like that. We encourage everybody to do that. But if you're looking at 6, 7, 8% beyond that, the first thing you need to address is your emergency savings. If you don't have that war chest in place and your money is locked up in the TSP and you're not old enough to access it, right now you're running into issues. So that has to be priority.
We're speaking with certified financial planner Thiago Glieger, a principal at RMG Advisors in Rockville, Maryland. And you mentioned something called tax loss harvesting. It starts to sound complicated.
It can certainly be complicated, but I think the idea with tax loss harvesting, people don't like the way it sounds. Nobody likes to lose money in the markets, but it's a really great way to, we tell clients, make lemonade when life gives you lemons in the markets, right? The fact that the markets are going down doesn't mean that there isn't a way to maximize your wealth when things are shaky. And this is a great way to do it. The idea behind this, and this is, you mentioned the non-retirement accounts, Tom, perfect place to do this, is when you have an investment that falls in value below the original price, you can claim something called a capital loss because its value is less than what you paid for it. This essentially creates what I call a tax coupon for you for future taxes. So then people will say, Thiago, now we're selling an investment at a loss. That sounds counterintuitive. And that's only true if you don't do the second step, which is then reinvest into something equivalent that also gives you the opportunity of regrowing that money again. So once the markets recover, your balance is back to where it was before, but you still get to keep that tax coupon and apply it, and it never expires.
And if you have sold your snake oil futures and instead invested in cryptocurrency, are losses in crypto, do those give you that tax coupon?
That's actually a good question, Tom. I'm not exactly sure how to answer that. With cryptocurrencies, there's a lot of different rules around that I would encourage people to check with their accountants on that one.
But basically, then it applies to those that are regulated securities under the SEC is where you're safe to have that tax harvesting idea. Okay?
You got it.
And then you're also advising people to review what is not down, because not everything, somebody's always making money in times like this. And you could be too.
That's right. Just because the markets are down doesn't mean every single investment in the markets are falling through the floor. Technology stocks have been very, very highly valued, very overweighted in the big market indexes like the S&P 500 or the TSP fund. And what the technology over the last decade has allowed people to do is still be invested in a very index fund kind of investment, which I generally philosophically believe in, not trying to stock pick, but just buying the broad market. But you can still be pretty active in your approach of asset allocation. So some parts of the markets do better when the economy is a little shaky. So which type of sectors are going to be best suited for you in any given environment?
And who are the people that make all this money on, say, just to pick one that's really a hot one now, the NVIDIA phenomenon? Earlier, it was the Apple phenomenon, or it might have been this phenomenon or that one. These companies that come along and just explode in reality as well as in capitalization, so that their stocks do this tremendous thing. You read the stories. If you had $1 of NVIDIA in 1927, you'd have $10 million today. Is that really something that people do very often, or is that more of a theoretical idea after the fact that that's what it looks like?
Some of it is being able to be in the right company at the right time, right? I have a client who has been buying Apple stock inside a Roth IRA for the last 30 years. And so huge account balances, totally tax-free. Some of it is genius. Some of it is just good luck having picked the right time to be in Apple. The other is really just understanding the fundamental of the company. Is the company positioned to offer a product that other people are not really able to compete with, like NVIDIA and all of the chips that they provided, right? And so this exploded at the time at which artificial intelligence really became a thing. And so some of those companies take off simply for that reason.
Right. And the other question I had for you concerns, and I've also known at least one investor over the year who bought and sold the same stock continuously because he understood its volatile cycles, but yet knew that it was fundamentally a solid company that was going to be there. So when it hit a certain point, he'd sell it, and then he would buy it when it dropped to a certain point, sell it, and so on. And he said he made $1 million just doing that.
That's impressive. We call that technical trading, right? Where you're looking at the markets, you're looking at the fundamentals, you're getting in at certain trigger points. And there can be a lot of good strategies around that. But I always caution the average person attempting to do this. There are factors that happen in the markets that are much faster than you're able to react to, and that can be very dangerous.